The last few months, many new companies came to the stock market, not only by filing an IPO, but also with something that is called a SPAC. It may seem like this is something new, but SPACs actually exist since the early 90s already, typically as a last resort for smaller companies to go public. But what is a SPAC exactly? A SPAC, or Special Purpose Acquisition Corporation, is a company that raises money through an IPO for the sole purpose of acquiring an existing private company at some point in the future. I want to stress the fact that their purpose is to acquire a private company. Therefore, the SPAC will bring the private company to the public markets. As a consequence, the term blank check company is often used to refer to a SPAC, as investors contribute capital without any prior knowledge of how the funds will be used. To say it in other words, SPACs are essentially shell companies with no actual commercial operations, but are created solely for raising capital through an IPO to acquire an existing private company. But how does all of this work? What does the capital structure look like? And why do many private companies prefer to go to the stock market this way, instead of filing for an IPO themselves? Well, let's first start with how a SPAC is created. A SPAC can be formed when a company submits the S-1 document at the Security Exchange Commission, or SEC. You've probably heard of them. This document marks its corporation as a SPAC. Then, when a SPAC raises money on its IPO day, those funds are replaced in an interest-bearing trust account. For a SPAC, this is done by selling either shares, typically at $10 a piece, or warrants, which are investment securities that allow investors to purchase more shares later at a fixed price. The money in the interest-bearing trust account cannot be utilized for any other purpose except to complete an acquisition of the target company, or to return the funds to its shareholders if no acquisition is completed by its closing date. The closing date is typically 18 to 24 months after the IPO date. Although if it comes down to it, the SPAC can request an extension of the time frame, and then the shareholders could approve or deny that request. If a SPAC fails to complete the acquisition by its closing date and the shareholders don't grant any extension, then the public shares will be redeemed with the cash in the trust account and returned to the shareholders. Now, if a SPAC does complete a successful acquisition, then the company is usually listed on one of the major stock exchanges, typically the Nasdaq or the New York Stock Exchange. So, what does the capital structure of a SPAC actually looks like anyway? Well, when investors buy into the IPO of a SPAC, they are usually buying what's called a unit. Now, a unit just stands for one share of common stock plus a warrant, which gives the investors the right to buy a share of stock later at a predetermined price at a specific time. Warrants can sometimes only be worth a half, a third, or 2/3 of a share of stock, depending on what was established when the SPAC was created. You might be asking, what does this warrant actually do? Well, a warrant, when exercised, actually provides additional capital for the company, since it provides the holder of the warrant the right to buy additional shares at a predefined price. But there is one condition. The structure of the warrant does not allow the investor to exercise until a specific event is triggered. That event can be either time, revenue goals, the share price of the existing float, and so on. But one of the risks that most investors are not aware of is that when warrants are exercised, or even forced exercised by the company in some cases, it increases the shares outstanding on the market, and therefore diluting the existing shares being traded. And then, what about the founders of the SPAC? What's in it for them? Well, they typically hold what's called founder shares, which entitle them to 20% of the common shares in the new company that has been brought to the market. Usually, there's a lock-up period of about 1 year on these shares, but in some special scenarios, the time frame could even be shorter. A lock-up period protects the interest of the market, preventing these SPACs from being a pump-and-dump scam. But getting 20% of the common share is a trade-off for the sponsor not being able to receive any salary or commission from all the work they do until the acquisition is completed. So why do private companies like going public via SPACs anyway? Well, there are usually a few advantages for the private firm, such as gaining the expertise of a sponsor who has brought other companies to the public markets already, or skipping the long process and large fees of a traditional IPO, which is a time-consuming process involving roadshows and pitch meetings with the other investors, and careful examination of the company's audited financial statements. And maybe the most important one for the founders of the private firm is that SPACs typically acquire companies at a premium, adding value to the private company for its earliest investors and the management team. But there are also advantages for us as investors, the most important ones being that we can also participate in a public offering, which is usually only accessible for investment banks when a company does an IPO. And the other huge advantage is the limited downside risk, as the funds are kept in a trust account and distributed again when no acquisition takes place. Of course, I could imagine that all of this sounds too good to be true, yet the biggest risk is the opportunity cost. It could be that the acquisition fails and you will only get your $10 per share back, while it could be invested in other assets that would have provided a decent return in the meantime. So, the bottom line. SPACs are just companies created by people or companies with great reputations. The SPAC raises capital and a private company is brought to the public markets through an acquisition. And if the SPAC acquisition works out correctly, then everyone wins. If you found any value in this video, please make sure to hit that like button, subscribe and turn on the notifications bell. Also, I love talking to you guys and I always reply to every single comment, so please let me know which SPACs you are interested in or would like me to cover next in the comment section down below. If you made it to this point in the video, thank you so much for watching and see you in the next one.